Hello, this is John Kvale, and this is your spooky Halloween October. Yes, it's October Capital Market Financial Planning Review, and I have a fantastic chart that I want to go over. That being said, I know that we've had a lot of new folks sign up in the last month. Thank you for your time. Wanted to let you know why we do this. I do this to put additional granularity on the subject matters that we talk about, and I do this on a monthly basis. That I go back and review a few articles that we posted, and then I do it on a quarterly basis in the newsletter. The newsletter tends to be longer. I always say this: keep your hands on the wheel if you're driving down the road, because we do this in a video, audio, podcast format, so you don't have to be looking at the video. You can just listen to it if you want. That being said, today I'm wearing my Sunday red. I'm recording this on Sunday, October 30th, before the football games. So I will not. I'll try not to be too long, but I specifically have a chart that I want to go over. I found a really good chart. So here we go. One reminder, our Dallas Museum of Art holiday party. Those of you that are in listen only mode, I've got to show everybody this. We reformatted this, and I'm showing the invitation. And when we did, somehow it knocked the darn date off of the invite. And so it is our traditional, we've been doing this for about the past 5 to 7 years, the Saturday before Thanksgiving. We do that for a couple of reasons. Most people are in town, and also we find that venues are easier to get to. So we hope to see you there. It starts at 2. We'll do a meet and greet from 2 to 3, and then we're hoping to have a dossier that will a dossier or two that will show us around. I am outside, so if you hear some outside noises, that's what's going on. Those of you that are in listen-only mode, I'm scrolling down to the first review. The new retirement contributions are out. I am going to post this to a page in this venue at Street Sense here. The reason being is it gets confusing, especially when we get into next year, because you have next year these new amounts. Those of you that are in listen-only mode, the new amounts, not surprisingly, went up dramatically because we've had a cost of living adjustment using Social Security of almost 9%, so the COLA adjustments flowed through to this as well. It's going to be easy for those of us that are age 50 and over, and 401k. We're at an even 30,000, 22,500 for those that are younger. And then where it gets confusing is when we get in next year, and some people will still be doing last year and this year. And that's why I want to post it on the website, because I look for this frequently. All right. With no further ado, I've been looking at this. I've created some of my own charts. Visual Capital came out with just a fantastic chart. Those of you that are in listen only mode, I am scrolling up to one of my favorite charts, and this is what's amazing. So in this chart, they say rates are rising as the fastest rate that they've ever had. And this is the current path. Guess what? Next week, they're going to raise it another 75 basis points. So this has created a headwind. I've had a lot of conversations with, this has created a headwind with our safe money, which is fixed income. Fixed income always has a headwind when rates go up. But usually, if it takes as an example, this 15 through 18, 3 years, you never even knew it. Your fixed income, every day that goes by, your fixed income starts earning you more as those investments reinvest, but you never knew it because they went up at a gradual pace for the most part. This time they're screaming up to counteract inflation and to slow the economy down. As a side note, they are slowing this economy down. No matter when the Fed stops, they've put enough pressure on this economy that the economy is going to slow. There's going to be a lot of talk in the future probably about when the Fed stops or when they slow down. When they do that, that's when fixed income instruments stabilize and very, very likely start going down in anticipation of the next slowdown. That's not going to help the equity markets. The equity markets, we've put this in place. But what's been unusual this year ever is that the equity markets have gone down and the fixed income markets have gone down as well, visibly because of this speed. So I know I keep harping on this, and as I looked at last month's article or review, I talked about this, but this chart was just too good to pass up. And it's still going to go up even faster as they raise another, most likely 75 basis points. That being said, that's all behind us. The fixed income markets will look forward. The equity markets, we still have some bumps and bruises. But I just love this chart, and I kind of buzzed through everything. So everybody, I've had a lot of conversations about this, and it's unusual. This is actually probably the fastest. This may be a once-in-a-lifetime move that we see the speed at which rates went. Basically from 0 to 4 in a few quarters. Unbelievable. We didn't expect that. I don't think the markets expected that. I've talked about this in client conversations that mortgage rates have gone up to 7, and that's really not healthy for the housing market. But this has happened so quick. We haven't seen a lot of this. Those of you that are in listen-only mode, I am scrolling back up to the top of the article, or to the top of this post. Happy Halloween. I'll post this tomorrow. And I thank you for your time, especially you newbies. We much appreciate it. And this is not a Steven Spielberg presentation. This is a content presentation, as you can see. But I do have my wireless speaker that gives better audio than in years past. All right. Thank you. We'll talk again soon. Bye-bye.